So in this video, we're going to be talking about Forex trading terminologies. Now, there are certain terminologies that you need to know when trading Forex so that when you're learning and when you're trading, you won't be lost in the words, right, and the languages being used. So there are mainly five terminologies that you need to know. The first one is long or short. I'm going to be explaining each and every one. The second one is leverage and margin. The third one is PEEP, bid and ask, and spread. Now, what is long or short? Long and short simply means your trade direction. So when someone says long, it means that you're predicting the market to go up. And when someone says short, it means you're predicting the market to go down. For example, when you say Euro USD is expected to go long, it means Euro USD is expected to go up. And when someone says I'm going long on GBP USD, it means I'm buying GBP USD. Same thing goes for the short side. If I say I'm going short on the currency pair, it means I'm selling that currency pair, or I'm expecting this currency pair to go down, right? So sell. So that's basically what long and short means. It's not that hard. Now, what is leverage and margin? Leverage is simply how much larger you can trade relative to your size of accounts, relative to your account size. Now, what that basically means is the broker is lending you a certain amount of money, not really giving you the money exactly, but it's giving you the ability to trade higher account size. So, for example, what that means is, for example, if you have 100,000, if you have $10,000 in your account size, let's say you have $10,000, right? USD. Let's see if I can draw this. Let's say you have $10,000 in your account. Now, and what you basically see when you're registering an account is the leverage is usually in ratios. So you have something like one to let's say 1 to 50, right? So what that basically means is your account size times this 50 that is here. So your account size is this one times this 50. So if you have $10,000 in your account, so this $10,000 times 50, that is $500,000. So what it basically means is if you have $10,000 in your account, the broker gives you, with this ratio, the broker is giving you the ability to trade a $500,000 account, right? So you can trade the size of a $500,000 account. That's basically what it means. So leverage is simply the ability for you to trade larger sizes relative to your account size. Now, margin and leverage they go hand in hand. So as you can see here, 100 over leverage. So if you have $10,000 in your account, it means the required amount for you to trade this size is 2%, right? What that means is if you 100 divided by, so this is your leverage is 50. So 100 divided by 50, that is 2%. That's 2. So in order for you to trade this size, you need to have 2% in your account in order for you to trade that size. So that's basically margin. It's kind of confusing for starters, but as you begin to trade, you get to understand it more when you begin to trade on your MetaTrader, because you see the margin there and you see your leverage. It's not really that important like that to know. One thing to note is that leverage is a double-edged sword. So it can kill you and it can bring you back to life. It can kill you and it can make you succeed. So what that basically means is the higher your leverage, the more size of accounts you can trade. That means the more risk you carry and the more reward you can carry. So you can make more money and you can also lose more money, right? So this is where Forex risk management comes into play. So you don't lose all your money, because if you don't manage your money well and you over leverage, this is what they call over leveraging. That's risking too much of your account size, right? Risking too much of your account size. That is what over leveraging is. And that can lead for you, without risk management, without proper risk management, you will blow your account multiple times, right? So to avoid that, you need to use proper risk management. What is PEEP? Right, so the full meaning of PEEP is point in percentage, and it is the fourth decimal number on a currency pair. And for the yen pairs, the JPY pairs, it is the second decimal. So what that means is if you look at currency pairs like Euro USD, GBP USD, the pounds, the majors are all the crosses except for the JPY pairs. You'll see some numbers. So you can have something like 1.2, let's say 0012, right? So the PEEP is basically the fourth decimal. So this is 1, 2, 3, and 4. So this is your pip value here, right? So if you want to know how many pips is on a currency pair, if you compare two currency pairs together, so let's say you have 1.000020, right? And you want to minus it from another currency pair, or another currency, which is 1.00010. So this minus this will give you one like this. So that means the market moved 1 pip, right? So that's how they do the calculation. The market moves 1 pip. So it's basically, if you want to know how many pips the market has moved, you basically do this calculation. But there are better ways of doing this, which technology has helped us, right? So there are softwares that can just, or you don't need to do the calculation. You just draw a line and it will tell you automatically how many pips the market has moved, right? So that is the old way of calculating the pips. So you just need to know that. And then when it comes to the JPY pairs, the yen pairs, the way it is drawn is quite different. It's drawn like this because it's the second decimal, it's not the fourth on the JPY pair. So you will see something like this. Let's say 120 points. Forgive my drawing. So this is 0, right? This is 0. So 120 points are, let's say, 1, 2, 0, 0. So the pip value here is the second decimal, which is, this is 1 and this is 2. So this is your pip value, right? So if you want to calculate your pip, you basically minus this from whatever currency you want to calculate it from. So that's basically how the pips work. Bid and ask. Bid and ask is very simple. Bid simply means the price you want to buy at, and ask simply means the price you want to sell at. And the bid is always higher than your ask, and the ask is always higher than your bid. So what that basically means is, when you're looking at the charts, right, your bid is basically down here. It might be blue, and then your ask might be red up here, right? So this is your ask, and this is your bid. Let me use a different color. Oh, no. So this is your bid. Ask is the red, bid is the blue, right? So if you want to buy, you're going to be buying here. And if you want to sell, you're going to be selling up here. That's basically how the bid and ask works. All right. So what is spread? So spread and bid and ask have kind of related in a way. But the thing is, spread is the difference between your bid and ask. It is also the transaction cost for your broker. And the spread also varies from broker to broker. So one broker spread might not be the same with another broker spread, right? And also it also varies from pair to pair. So that means the spread on GBP USD might not be the same on the spread on GBP JPY. Mainly, most of the time, the crosses usually have higher spreads than the majors, right? So the spread on the crosses have higher spreads than the majors. And if you're trading exotics, those have the highest spread. So it's not really advisable to trade exotics because of the transaction cost is quite high. So it's not really that reasonable to trade that, right? So